Welcome to this week's special presentation, this week titled 5 Tips to Defend Your Portfolio. My name is Todd Shaffer, Manager of Research for VectorVest. I'll be your presenter this evening. Now, market corrections can be a nerve-wracking time for investors as they witness their portfolios undergo a drop. While there are various techniques available to protect your portfolio from drawdown, there are also things we can do proactively to mitigate risk. As the saying goes, an ounce of prevention is worth a pound of cure. What are the things we can do to improve our prospects before our portfolios come under pressure? Broadly, these steps are always to diversify the risk to our portfolio. Our first tip is to diversify or spread your risk over time by spreading out your entries. In other words, when the uptrend is first beginning, you need to slowly increase the number of positions in your portfolio. By slowly adding positions to your portfolio over time, you limit your risk. If the market turns around on you, you've only got a small percentage of your portfolio in the market and therefore at risk. So let's take a look at an example of how you might do that. Here's our market timing graph, and the green light buyer signals are on that graph, so each triangle represents a new green light in the price column of the color guard. So as we come off of the low and we get our first green light, which is, by the way, the timing signal we use in Successful Investor, each time we get a green light and we get follow through, we take on just a couple positions, maybe 2 at a time, 1 at a time if you even want to be more careful. In this example, I've spread my entry over 10 days. So if the market has a quick reversal, I have less money at risk. Late in the run, I will also have fewer new positions exposed to a full stop loss. Of course, the downside is my gains will accrue more slowly if the market continues to run. So the first tip is to step into the market, diversify our risk over time. Our second tip is to diversify our risk across multiple industries or sectors. You've heard it said, don't put all your eggs in one basket. The idea here is to have no more than 20 to 25% of your stocks in any one industry, typically 1 or 2 positions. The idea is that stocks within the same industry often move together. When the industry falls out of favor, the stocks in that industry get hurt. Typically, as the market cycle matures, traders become more narrowly focused on fewer and fewer industries and individual stocks. Most recently, we saw this happen in the tech space. If you're too heavily exposed to that industry, when the market finally breaks, you risk an outsized drawdown in your portfolio. Tip number 3 is to define your maximum loss. When asked about controlling risk, most of us think about stop loss selection. And while stops are important, they're only part of the equation. The stop is a tool to control the trade, but if we define risk by how much we stand to lose on a trade, we'll also have to know how many shares we're trading. So more on that in a moment. But if risk is defined as how big a loss we're willing to accept, it begs the question, what's an acceptable loss? How each of us defines acceptable is subjective. Dr. DeLito's guidance was to limit our losses on any individual trade to just 1 to 2% of our portfolio's value. Favor the lower end, particularly if you're less experienced. Remember, that's a max loss. If you want to make it smaller, you certainly can. This approach lets us live to fight another day if the market tanks on us or we make some mistakes. So only risk losing 1% of your trading account on each trade. So let's play that out. I have a table here with various portfolio values, and the 1% and 2% values of that portfolio. In other words, a $50,000 portfolio, 1% of $50,000 is $500. So if I wanted to risk only 1% maximum, I would be willing to lose at maximum $500. That's a 1% risk. 2% would be $1,000. So we're not talking about your stop loss, we're talking about how much money you would actually stand to lose if the trade moves against you. By the way, if you have fear of loss issues, resize your max risk within your comfort zone. until you build confidence in yourself as an investor or trader. So if you have a $50,000 portfolio and you trade a 10 stock portfolio and lose $500 on each of those positions, your portfolio would fall from $50,000 to $45,000, losing that $5,000, 10 trades at $500 each. Well, I can still trade, right? If that happened to me, I haven't wiped myself out. I can survive to fight another day. Not that I'd like it, but I would survive. By the way, if you're a 50-50 trader, it would be rare that you would ever get shut out on all 10 of your positions. But if you do, please stop and identify what's going wrong with your approach instead of just dying a death of 1,000 cuts. So now we're stepping into the market, diversifying our risk over time. We diversified across industries. We've defined our maximum risk for any trade and by extension, our portfolio. Now let's get consistent performance across the portfolio by dollar weighting it. And what I mean by dollar weighting is you want to spread your money equally among the stocks that are in your portfolio. So no one stock controls the success or failure of the portfolio. If you're overweighted in one stock and that one stock decides to go down, it takes the entire portfolio with it. So let's avoid that. Let's take a look at how to mitigate that risk. While there isn't a hard and fast rule of how many stocks you want to carry in your portfolio, we can say generally, the more volatile or active the portfolio is, the fewer stocks you should trade, as they each are demanding more attention. On the other end of the spectrum, a slow-moving large-cap stock portfolio would have lower volatility and require less attention. And that's kind of a nice natural alignment, whether you're an aggressive, prudent, or conservative investor. Recognize also the more stocks you hold, the smaller each position would be, which spreads the risk out over more tickers, and given the same stop loss would have a smaller monetary loss the smaller the position. So bringing all these together in tip 5, you want to properly size your positions. In other words, you want to make sure to buy the right number of shares to ensure you dollar weight your portfolio and you follow the 1% rule. So we already know the maximum amount we're going to invest in each trade and the maximum risk we're willing to accept in each trade. What we need to do now is to calculate how many shares to buy at the current market price. And we need to confirm that if we get stopped out, we won't exceed our maximum risk. Sizing the trade is simply a matter of dividing the total dollars per trade by the stock's price. And usually this will be pretty close if we're trading a reasonable stop, for example, the VectorVest stop price. But we want to make sure, so we're going to do the math. But first of all, just see this relationship. If I have a $20,000 trade and the stock's current price is $100, I would buy 200 shares. If I had a $5,000 position at the same stock price, I would only buy 50 shares. So I'm controlling the risk in the trade by controlling the number of shares I buy, not the placement of my stop. Although they work in concert or work in tandem, the trade size, the position size, is the controlling factor. So if you want to be sure, you want to calculate the per share risk at your stop loss. So the way we calculate the trade risk is the current price of the stock minus your stop loss value, and that'll give you the risk exposure or the trade risk for that particular ticker. Now, in Successful Investor, we like to select our stop loss to allow the stock to do what it normally does. We call that giving it room to breathe. And we'll use our stop loss vehicle, in which case we use the VectorVest stop price, to set our initial line in the sand stop that defines the maximum risk in the trade. So to calculate that risk, I'll take the risk exposure between the price and the stop loss times the number of shares. That gives me the total risk for that trade. That should be under my max risk number. If you want to express that as a percentage, then divide it by your portfolio size. Now you have all the levers you need to manage the trade. As that trade develops, presumably rising in price, as it develops, we can further limit the risk and or start capturing profits by adjusting our stop or closing part of the trade. But that's really a different conversation about how to manage your position. Putting it all together, a well-constructed portfolio, a diversified portfolio, will be easier to manage and protect when the inevitable storms buffet our portfolios. If you'd like to learn more on this topic and really drill down into the specifics, we teach this in Module 5 of our Successful Investor course. It's free for all members, and it starts next Wednesday, so come join us at VectorVest.com/TSIC to register. But I thank you for watching. Have a great night.